Okay, so welcome back to part two of understanding institution reference points. So in part one, we went over the bearish institution reference points, where we talked about the eyes, bearish rejection blocks, bearish order blocks, bearish mitigation blocks or breakers, sell side imbalance, to buy side inefficiency, which is what we call CB, and also bearish liquidity voids. Now we're going to go over the bullish side of the institutional reference point. So what you need to be referencing bullishly in price action. This is what we're gonna be covering on today's call. And again, just like the left side of our screen, we can see all the special rejection blocks, special blocks, special mitigation blocks. So all you're just gonna do is you're gonna flip everything to the bullish side, and it's pretty much the same concept or the same theory behind all of this. For example, when you have old lows in price, it's like we went over in part one. That oftentimes is going to be a sign that there was some activity, price action that changed price from a downtrend to an uptrend. And oftentimes, all lows are going to form around, or lows generally are going to form around higher time frame support level. When you're looking at a discount out of the marketplace, a discount simply is anything below the 50% Fibonacci for a bullish move. That is a discount. So all lows generally do form, especially turning points in the marketplace. Again, when we talked about OLAS, we talked about intermediate term swing guy, long term swing guy, and also short term swing guy. So now when we're talking about old lows, we're talking about intermediate term swing lows, short term swing lows, and also longer term swing lows. So when we're referencing all these tend to occur at higher time frame support level. Okay, but now when we're looking at old lows, oftentimes there's going to be liquidity that forms around short-term lows, intermediate-term lows, swing lows, and also long-term swing lows. And basically, if you are selling in price action, this can be areas to take profits at on the old lows because there's going to be liquidity on the fund basis or on the interbank basis that's going to rest below those level that price we want to reach for because again the market is influenced by liquidity in price action. So number two, the bullish rejection block. So again, we talked about bulk of a the bulk of orders coming in at the body of the candle, and whenever you see equal bodied candles, that often sets up a rejection block. So now you can see in this example, we just talked about old lows, and oftentimes that can also be a place to buy from as a terror soup. You can see in this example, we run under the wicks of these two candles. So all those usually you're going to consider the wicks of the candle. Rejection blocks, you're only going to consider the bodies of the candle. Now, there's different situations where you're going to reference rejection blocks or uh, the wicks. So when you're referencing the wicks, that is what we call old lows. When you're referencing the bodies of the candle, this is what we call rejection block. So now there's situations that could present uh, target for rejection block. Remember, rejection block are candles that are actually equal bodied candles in price. So this was an example of getting a terror soup long from old lows because again, liquidity is going to rest there. We're just going to put this dollar sign there. So we're going to see liquidity resting there on a fund basis. You can see when price made a false swing low at this level and traded breaking above this market structure. There's going to be some of the banks or the hedge fund or investment firms are actually chasing this bullish move. And if they're chasing this bullish move, thinking it's a buy, they're gonna buy steps above the marketplace. And once market starts going higher, they're gonna protect those buy stops with sell stops, and that's gonna create a counterparty for the banks, the large banks, central banks to sell into if they want to buy to see higher prices. So this presented a trade scenario, but now you can there's times where you can consider the bodies of a candle. Okay, so now we're seeing this as a perfect example. You can see that we have this. Now I want you to look at the way this all lines up. All right, so all of this price action comes inside the body of this candle. That makes this a rejection block, not an old low. Okay, because we're considering the body of this candle. So if you have reasons to believe that you're bullish and you see an old low there, okay, if you go to the smaller time frame, it's going to be like equal lows on the 4 hour time frame. But what we're looking at is the body of this candle. Right, so if we price gets down under this low and we're seeing the DXY making either lower high, okay, showing figure swing bearishly, or we have reasons to believe that the DXY wants to be bearish. That's going to mean that bullish foreign currency is going to be bullish. And if foreign currency is going to be bullish, that means Aussie should be bullish. Okay, so Aussie, that's going to indicate bullishness for Aussie. So you can then go into the marketplace to anticipate this being a Cherry for a long in price action. So this is going to be a Cherry long price action because now we're looking at the body of this candle because of the number of price action inside the body of this candle, telling you that this is a valid rejection block. So remember, rejection block is equal body candles. I'm going to take this here again. You can see equal body candles rejection block on the daily time frame. Price goes just under this. So now when you're seeing price weak levels like this and DXY is bearish, you're using this in confidence with the DXY. So if DXY is bearish and you see this making a lower low whilst DXY is making lower, you know that is not meant to happen in price. If DXY is making lower lows, all foreign currency should be making higher highs. But now, or higher lows, sorry. So if this is making lower lows, DXY, foreign currency should be making higher lows just by using relative strength analysis. But now, if DXY is making lower lows and foreign currency is making, if DXY is making lower highs, and foreign currencies are making, one of the foreign currencies is making a lower low, that indicates that there stops being run out, and this is usually going to come under an old level. So now when you go and look at that old level and you see that just equal bodied candles, you can then go into reference that equal bodied candles rather than referencing the wicks. Because especially when you see huge wicks like this, that could mean a winner's price action. So what you want to do is you want to reference the body of the candles, not the wicks. Okay, so when you see levels like this, what you want to reference is the body of the candle and look at the price action that comes in at the body of this candle, because there is some form of take profiting under this level before we break to downside. Again, you can also see that we test back at that level because that was actually a valid level in price action. So this is what we do when we see equal body candles, which is what we class as a bullish rejection block. So I give an example of a bearish rejection block, which is equal body candles to the top. You can see that this is equal body candle to the top, and you can see price running through. I give an example of GU the last time. So this is just an example of this. When you see price action like this, just a lot of price action around the bodies of the candle. You can see this body, the close, the open, they're pretty much at the same price level. So that becomes a rejection block for us to reference in price. Also, we can see this example here. I'm going to zoom in. This is going to be the last example for rejection blocks. So obviously we're bullish. We ran under this low. There's liquidity above the marketplace in form of this week. Okay, so now this is the week we're going to consider because this week broke the swing. So there's the swing high to the swing low, and we're looking for liquidity above the sides to get taken out and above the sides to get taken up since we're bullish. So that is all that is for us as our target projection. You can see now that it seems like we had equal lows here, but that is false because we ran the bodies of the candle. Look at this equal body candle. So that is where the bulk of volume would be at, equal body candle. So whenever I see price action like this, those are levels that are very clean. So that could present your scenarios for longs, especially if there is an higher time frame target. Just know you're very near. Price is very near higher time frame target. You're gonna see situations like this where you're gonna run out light liquidity and then expand to the upside, which is what we saw in this price action. So that is that. Let me zoom in here real quick. Okay, so I think we're good to go. Getting back to our reference points, we have the bullish order blocks. Again, remember the institutions don't buy in up moves. If they want to go bullish, they're buying down moves. So when the market is going down, this is when they're buying. So you're doing the majority of your buying in down candles. Okay, so we're gonna look at the bullish trend and consider the down candles in that bullish trend. Because remember, due to the sheer volume of orders, the banks are going to buy in down moves or when the market is bearish. And as the market goes higher, they're going to allow price to come back to an old buying region. So again, remember the banks buy in down moves. Now, if we see price run under this low and we understand that it's a torso because DXY is making lower highs and this is making lower lows, that shows divergence between these two, or that shows break in or a crack in correlation between Aussie foreign currency and the DXY. We understand that this is actually bullish. Okay, so what we're gonna ask ourselves is, where is the last down candle prior to the outcome? So once we break the market structure, remember the banks bought in this down candle. So the validation that the banks bought in this down candle is that swing higher above this down candle. Once we see price move higher above this down candle, what we're going to reference is the candle itself. So what the sensitive points in the candle is the wick of the candle when we're looking at down candles, the open of the candle, and the mean threshold, which is the midpoint of this candle. That's what we call a mean threshold. We're going to explain more on mean thresholds as we advance into the course, but this is the main threshold, the 50% of a candle. Those are the sensitive points for a bullish order block. So if you're considering a bearish order block, which is the last up candle prior to down move, what you're going to consider in the bearish order block, this is an up candle prior to this down move. So the sensitive points are the week. I'm going to remove this. Sensitive points are the week. Okay. The wick of the candle or the low of the bearish candle for of the bullish candle. Actually, if it's a bearish candle for a bullish move, you're looking at the high of that candle. But if it's a bullish candle for a bearish move, you're looking at the low, the open, then the midpoint. So you're going to measure again 50%. So when you're measuring the 50%, you measure from open to close, not the wicks. You don't include the wicks when you're measuring the mean threshold. Again, remember the volume of or the bulk of orders comes in at the body of the candle, not the wicks. So we're measuring the range of trading inside of that up candle, and the 50% is going to be our mean threshold. Again, I'm going to elaborate on this more as we go into the course. So you need to worry about this. So this is our sensitive point. You can see that how price basically reacted off the open of this candle here that started all of this down moving price. So that is something really important to note in price action. So if you're looking at down candles, the sensitive points in those down candles are the high, the open, and the 50% of the body of the candle, which is what we call the main threshold. So basically, we're measuring the range where the central banks bought into, or the smart money bought into, because again, they're buying down candles. So if we see a break above this down candle, what we're going to reference as our sensitive point is the wick, the open, the eye, open, and the midpoint. You can see how this came in at the midpoint. Remember, this was the candle where we broke above this daily range. So I call this a daily range because this is where they dealt in price to buy the market up. And once you see that expansion higher indicating that they've bought, so this retracement back to the main threshold is something you can go along in because again they're buying down candles. All right, so as we go higher, you're looking for old eyes to get run out because there's going to be liquidity resting above those old eyes. So you're looking at the old eyes here. Once we run through old eyes, they allow price to trace back to an old buying level. Where's that old buying level? Again, you're going to reference these two candles, these two down candles prior to the up move. You're not referencing this candle because all of this came inside this dealing range. This was where we broke above the dealing range, so this is what we're referencing. Not this candles because again, this is just inside of this other block. So we're referencing this candle. Look how they came back down into the candles and then they bought some more. So if you extend this out, again, we're going to use the open of the candles to the close of the candles. This was an old dealing region for the central banks. You can see that expansion to the upside as they bought more. They bought more into that move. Again, you can see that this was 1-2 down candle prior to the up. If you're not looking at this up candle, you're looking at the last down candles prior to the expansion. It's here. We trace back into down candles. They bought some more and then ran into this old selling range, which is this up candle prior to down move, what we call a bearish shadow block. So this is how you're going to reference bullish shadow blocks in price action. That's just basically like a basic way to reference on bullish shadow blocks. So as we go more into the course, we're going to do more exercises on and explanations and insights on other blocks, bullish or bearish shadow blocks. So now number 4, bullish mitigation of breakers. Again, looking at this price example, remember a breaker is when I explained the last time, when we have a short-term swing low and we run through a short-term swing low. I explained bearish breakers when we run through short-term swing, guys. So here we have the short-term swing low. Here, this is swing low again. Down candle, higher candle, higher candle. That makes this a swing low. So we made a swing low here, and then the last up candle was where the bot sold into. Remember, the banks or the institutions or smart money sell into bullish candles. So they sold into this bullish candle to run out the short-term liquidity under the slope. So we're going to mark this as an X. They ran out the short-term liquidity under the slope and then expanded to the upside. Now, once they expand to the upside, you're going to liquidate their sold position. Okay, remember they sold down to zero to run out the sell stops under this low. So they sold inside of this bullish candle. Okay, you're gonna mitigate their sold positions by buying off their sell positions. So that means you're gonna liquidate your sell side positions here before they run through for this liquidity. So that is basically how they hedge their positions in the marketplace when they try to run out liquidity. So this is what we call a bullish breaker. A bullish breaker is when we run out liquidity, and a bullish mitigation block is also the same thing. So this is a bullish mitigation block. It's basically the same thing as a breaker. So whenever you see the last down candle prior to an up move, an up candle prior to a retracement before we expand, those are what we call mitigation blocks. So buy side imbalance, sell side inefficiency. So that's just like a fair value gap kind of in price. That is a place where there's only one type of marketplace offer. So you can see we have the dealing range here. Now if you look at this, this is just one. Right. So if you set this, this is the last place where sell side was offered. So in between this low and this high, there was no sell side offered, only buy side. So we can look at this as a BC, which is a bullish fair value gap. And if we see a short-term shift in market structure, we can expect that to be a targeting price for price to reach for and fill, because that becomes an inefficiency for price action. So when we talk more about IPD, we're going to explain more of this inefficiency in price action. And how basically the interbank delivery algorithm works when it comes to this. So this is simply a bullish fair value gap. That is buy side imbalance when only one side of the marketplace is offered and the opposite side is not offered. That makes for an inefficient dealing range that price is going to seek sometime in the future. And there's going to be more explanations on this. And lastly, bullish liquidity voids is when you get gaps in the marketplace that are bullish, and that could be a reference for an upswing in price. So when you have levels in the price where there was no price fill at all, you're going to see points whereby price is going to fill that up again in the future. You can see that there was this open here and there was this close here. We can just put this. So we can see that gap on the daily time frame. But if we go down to smaller time frame, we're going to see that there was a gap there. The price eventually filled Let's go down. This is still. I want to see that gap. I think it's actually filled more quickly. All right, so you can see this was the down. We had the colors here, and then we opened down here. So this was the last close of price. Price closed here, and then we opened down here. You can see eventually price came all the way back up to filling that range, and even came all the way back up to filling all of this CB, which is sell side imbalance by selling efficiency before price dropped. You can look at the dailiness of this range. So that is a bullish liquidity void when there is a gap in the marketplace. So you can expect the market to go and fill that up sometime in the future. So that concludes our reference points, and we're going to, now that you understand reference points, we can go and start our course fully. I'll see you next time. Trade safe.